So welcome to our 10th week of the Genus in Focus COVID-19 video. We are giving Leslie Cliff, our co-founder of Genus, a week off, and my name is Mary Lee Miles, and I am the Director of Wealth Management here at Genus. And I've been with the firm for just over 15 years, and I came to the firm from a previous firm that I worked at, Maxima Investment Management, that was founded by Dave Muller and Genus bought in 2005. So I'm pleased to say that most of the clients at Maxima came to Genus, and the majority of them are still here today, including a few of you that are watching this video. So I work with a great team of portfolio managers that focus on servicing our clients, making sure their financial goals are met, and that their investment portfolios reflect their values and their needs. So we really encourage you to reach out to them and talk to them whenever you're feeling the need to have questions or anything about, like, for example, this video today. So we're all passionate about what we do. We're all working from home. And so that's making it an interesting venue, but we are available to video chat or email or call. So over to my role today is, of course, to do what Leslie was doing, is put Wayne's feet to the fire. So Wayne Michelle, our CEO, our Chief Investment Officer, and the architect of our investment process. So Wayne, as usual, let's start off with, now that the world is opening up, the economies of the world are opening up, including Italy, and of course we here in BC are in phase 2. What have the markets done this week?
Well, as you mentioned, things are opening up. And that was the big news this week, was that we saw mobility rates go up across the world, which was good news. And also a bit of a breakthrough on the drug side in terms of Moderna has potential immunization products. So good news from that perspective, in spite of all the dark news on the unemployment side. That was the big marginal good news this week. And that got the market up. And the winners from the previous month or so, the technology and healthcare, took a bit of a break. And the cyclical areas that have been beaten up, represent some value, came back pretty strong this week. The financials, the oil and gas and industrials all did quite well this week. And so it was good to see that change in leadership for the week. So the market was up marginally. It's been going sideways the past couple of days here. There's been a lot of questions. I think the most popular question I've seen all week with the talking heads has been, why is this market so disconnected from the economy right now? Well, the economy right now is the current, and the market looks into the future. And it's looking 6 to 9 months down the road and saying, with all the money being printed, with all the government spending, and with the economies opening up, things are going to improve. And so that's just been going on and on. The only really, I'd say, sort of negative news this week was just the more evidence of Chinese-American Cold War opening up here a bit. There was a bill passed in the Senate, which was bipartisan, forcing the Chinese tech companies that are listed in the U.S. to adhere to U.S. accounting standards. And so there's a bit of a blowback from that, but we think there's going to be long-term tension between those two countries, probably right through the election. But generally, a good week in terms of marginal news, in terms of the economy opening up, mobility getting better, and hope on the drug side as well.
Yeah, hope's always good. What about on that note, what about the Senate Banking Committee issue on Tuesday with Jay Powell and the head of the central bank and Stefan Menashe's testimony in front of the Senate Banking Committee? Were you concerned about that?
No, I think number one, the banks are in much better shape than they were back in 2008. In 2008, the banks were the problem. And that's where all the mortgage problems were in the banking system. So they were the big problem. They're not the problem. The problem right now is a health issue where the government's forcing the economy to close down and then open back up again. And so they're not the problem. And in fact, they're trying to help the problem in terms of be the ones that are dispersing some of the monies from the government spending. So it's, I'm not that concerned. I don't think, there were some issues around dividend cutting. I don't think they're gonna have to cut their dividends, but we'll see where that all goes. But the banks are much better shape than they were in 2008. And the economy was strong going into this whole slowdown.
Well, speaking of dividends, on the Saturday report on Business in the Globe and Mail, there was an article on goodbye to fixed dividends. So I know we've been talking about dividends a lot over the past few weeks, so maybe you could speak to that article.
Well, I guess the premise of the article is that companies should let their dividends go up and down with their earnings. I don't think that's going to happen. The dividends policy is really a signaling mechanism between management and shareholders, and it gives the management's long-term perspective if they're going to raise or cut their dividends. So I think it'll remain in place as a signaling device. And however, I'd say some of the cyclical areas, like a mining company, for example, that earnings go up and then really get blown out during a recession. Maybe those companies should, let their dividends go up and down with their earnings. But I think for the majority of companies that have stable growing earnings, they're going to keep their fixed dividend policy.
That's great. I've attended the International CFA Institute virtual annual conference this week. And one of the questions that came up for in one of the sessions was, will companies that are going to be facing, lower revenues and having to cut costs, will they address maybe stop or reduce some of their environmental, social, and governance initiatives that they've started?
I would say generally, if a company has severe solvency problems, they will cut to the bone. Everything will be cut. But in general, I think if companies have a bit of a downturn in earnings, they will not give up their ESG. It's like saying, because our earnings are turning down, we're going to stop with our good governance. Governance is part of, keeping you in business and part of your basic function. So, and also a lot of the ESG requirements that firms are focusing on are their marketplace demands that of them. So their customers demanding that of them. And so I think they will adhere to those. They'll be probably cut back as per their budget. But I think in general, companies will adhere to their ESG policies or strategies unless they're in dire shapes where they will cut to the bone.
Yeah. Hopefully that's true. The last question I'm going to ask, Wayne, is the question that I get from a number of clients, and it's come up on the video too, is how is Genus doing during this pandemic, we as a firm?
Well, there's two aspects. The number one is the operational and the financial side as well. The operational side, I'm really proud of our team. We haven't missed a beat. We actually raised our game, I think, during this whole process in terms of our money management, in terms of how we're interfacing with our clients. So I'm really proud of the whole team and what we've done there. Everybody is working from home. I think longer term we'll have maybe a quarter of our team will work from home. Our technology folks will definitely work from home, I think, longer term, and probably even more. So, it's operationally, we're doing really well. I'm really proud of the team. I don't think we skipped a beat. Financially, of course, our revenues go up and down with our clients' performance. And so if the markets are down this quarter, our revenues are down a bit. But on the other hand, we're saving money by having the office closed. We're doing less entertaining, less traveling, for instance. I'm doing a short list tomorrow, and normally I'd be on a plane flying to Toronto for that, but it's going to be a Zoom meeting. So we're saving money on that side and less entertainment. And, in terms of entertainment, usually every July we have a reception for our guests on a rooftop back at the office. That's not going to happen this year because of what's going on, obviously, with COVID-19. So we're going to make a donation of about $25,000 to the Greater Vancouver Food Bank, in lieu of that, because we feel fortunate just in terms of how we've been doing and how the firm is working and how we've made out financially. So it's time for us to give, I would say.
That's great, Wayne. I know that donation we're making to the Greater Vancouver Food Bank is every dollar you make there it's matched to 3 times. So that donation actually works up to $75,000. So that's a great thing that Genus is doing. So I have to say, I heard this phrase a number of times over the past few weeks, and it's basically saying that we are all in the same storm, but we're in different boats. And I think that it really resonates with me, and I think that's really true of our clients, and that's why I really encourage you to call your portfolio manager and talk about your circumstances and what we can do for you and make those connections and keep those conversations going. It's really important. I know that I personally this weekend first of all, I'm looking forward to phase 2 and getting a haircut. And secondly, I am also looking forward to spending the weekend. We are having our new grandson over, Oscar, for brunch this weekend, and he hasn't been to our house since the beginning of March. So I am really excited about expanding the bubble and hoping. I know that a number of us are looking also forward to when a few weeks from now, and hopefully we can see some of our older relatives closer up. So we wish you all a fantastic. Thank you for listening. Make sure that you do reach out to us. I look forward to hearing your comments about today's video. And please stay safe, healthy, and keep resilient. And we'll see you next week.